Hi, this is Jim Cramer, founder of The Street, and I'm with Dan Dicker, our energy expert. And I've got to tell you, Dan, there's something that has been befuddling people. It happened with my friend David Faber this morning. What the heck are oil prices, particularly Brent, doing so high, given the fact that we seem to be discovering oil every day?
Right. The EIA report came out yesterday or 2 days ago. And again, no matter what numbers we seem to come to in terms of recoverable assets, they seem to go up with every new report. And this latest one from the EIA, again, it increases the amount. Another 10% in terms of shale oil, another 30% in terms of shale gas. All of these figures would seem to think, and you are pointing it out, that in fact we should have a lower price for some of these. Fundamentally, we should have a lower price.
What I put in my realmoney.com piece was that, okay,
Right.
iron ore goes down when we have oversupply, aluminum goes down, nickel goes down, copper goes down. Why isn't oil going down?
Okay, there are two major reasons why oil is going down. One of them is directly connected. Yeah, one of them is directly connected to the Brent market itself, because the Brent market is a slowly disintegrating market in terms of fundamental supply. The North Sea has been dropping in terms of what it can create. Okay, and because, unfortunately, and I would say very much unfortunately, because most of the financial world for oil is now connected to the Brent price, we are unfortunately tied to what is a lowering supply profile for a very small marketplace that is 100% or mostly connected financially into the rest of the oil world. So that's a mistake that needs to be righted. I don't really know how to do that because everybody's prices, everybody's Globex is connected, everybody's CME prices, everybody's
That's incredible.
Intercontinental prices, all their swap prices, they're all connected through basis prices through Brent, and that's become a problem.
If LIBOR didn't work, well, we know LIBOR was manipulated, but here is just a case where it just has to do with a declining field.
That's correct, and it's a mistake to have that financially connected almost 100% to a declining field profile, but that's what you've got. The second reason, of course, is something I wrote extensively about in my book, which was about the financialization of oil and the fact that money has played such a large part, in fact, the overwhelming part in terms of pricing, and it's not fundamentals. Fundamentals often get swamped by the financial forces that are inside the oil market, and that, again, has been a part and parcel of the dollar, been a part and parcel of a stock market that's been very strong, been part and parcel of a recovery that's been going on in the United States and elsewhere. It's been about what's been at least a decent growth profile for China and other emerging markets. All of that has been driving money as a risk-on kind of trade into the oil markets. And those two things have been the major reason why I still continue to believe that the risk for oil is not being short, it's being long. You cannot be short oil here. The charts continue to tell you the market continues to make higher lows every year, 2009, 2010, 2011, 2012. I don't think 2013 will be any different whatsoever. We won't see an oil price, unfortunately, anywhere lower than the high 80s.
Wow. Dan, I've got to tell you, you've been dead right on this. I want to thank you for your insight because it's the best there is. Dan Dicker, our energy expert. This is Jim Cramer. Stay with us.